It's been called the Google tax, which won't thrill Google. The Australian budget speech, the first delivered by new Treasurer Scott Morrison, contained the sentence, everyone has to pay their fair share of tax, especially large corporates and multinationals. And to encourage them to do this, Mr Morrison is doing exactly what the OECD is hoping governments will do, tackling profit shifting. What is that? Well, in short, multinationals like Google, Apple and Facebook are able to declare costs in high tax areas and move profits to low tax areas. Tax is still paid, but at the lowest rate that they can find. Not anymore if the Australian government has its way. To explain it, I spoke to ABC business reporter Michael Yanda on Skype video.
Basically, they're bringing in what in the UK is known as the Google tax, which the proper name is a diverted profits tax. And it's basically where largely tech companies, multinationals, shift a whole bunch of their profits overseas through licensing agreements, intellectual property licensing and things like that, where they pay big fees from, say, their Australian or New Zealand or UK subsidiaries to subsidiaries based in tax havens for intellectual property that apparently comes from those tax havens. But of course, it probably comes from San Francisco, but they don't really want to pay the tax there either. And this is intended to put a 40% tax on any profits shifted overseas like that. And given that the Australian corporate tax rate is currently 30% and slated to fall to 25% over the next decade, that's a fairly big disincentive for trying it on.
Yeah, it is. And on the face of it, it's persuasive. But how do you police it? And how do you know what is a legitimate cost? And how do you know when profits are simply cynically being shifted?
Well, on the policing front, the budget had a large measure to restore some of the funding that was pulled out of the Australian Taxation Office in the current government's first budget in 2014-15. So they cut about somewhere between 3,000 and 4,000 tax office staff. They're bringing back somewhere around 1,000 into this task force, which is going to focus on multinational tax avoidance. There's an extra 680 million Australian dollars for those extra staff. And basically, this new diverted profits tax puts the onus on the companies to disprove that they're shifting the money overseas for the purposes of minimising tax. So if they're shifting money from Australia to a country overseas where they're going to be paying less than 80% of the tax that they would have paid here, they have to show the tax office that they're doing that for a legitimate economic reason, such as the fact that the intellectual property really did come from workers in that country and it really does belong there. If they can't prove that, then it's up to them to take the tax office to court. Otherwise, they'll be paying the 40% tax.
Gosh, so this on the face of it seems like the kind of response that the OECD is so desperate for. How have Apple and Google and Facebook and the kind of multinationals that are doing this responded so far? Have they said anything?
We haven't had a huge response so far from those companies because along with this measure in the budget, there was also the announcement of a glide path down to the 25% corporate tax rate over the next decade. That's probably got more of the headlines here so far from the business groups, which of course they're pretty happy about, even though it is a long way off. And I guess that's also designed to make less incentive to go and pursue these arrangements. So it's a bit of a carrot and stick. We'll charge you less tax if you declare it here over the future, but if you keep shifting profits offshore, you're going to get whacked.